Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. That's Big Al Clopine. Thanks for tuning in. Talking plan giving, figuring out ways to reduce your taxes before it's too late. Alan, did you know that you can't bring one pair of underwear to
Paris?
To Paris?
We just learned that from our cameraman.
You can't do it. You cannot bring one pair of underwear to Paris.
That's what we just heard. I think it was in reference to a second monitor that we need.
Yes, so yes.
Anyway, we're good.
If you're going to go to Paris, make sure that you bring more than one
That's
pair.
the main thing.
That is
if
the
you
main
learn
thing.
anything today, that's the thing.
That is the main thing. All right, hey, if you're thinking about saving money on taxes, this is our favorite time of year because Big Al and I do a tax planning course. If you want to go, take a look.
Get out of the tax trap. Join Pure Financial's Joe Anderson and Al Clopine December 3rd for a free end-of-the-year tax planning seminar. Minimize your taxes on your IRA and 401k. Grow your retirement income tax-free. Create tax deductions when the market goes down. And much, much more. Register today by calling 855-99-TAXES. That's 855-99-TAXES.
Yeah, well, definitely love to see you there. It's a couple of hours of fun, but more importantly, it's a lot of information to help you figure out what you need to do in this crazy world that we live in regards to your taxes. Let's talk in more things about the true-false question that we just played.
Okay, good. Let's see. If I give away old clothes and appliances to charity, I can deduct the current value of those items on my tax return.
You know, I want to know about this because let's say that I have some old suits. I know you and I talked about this before. So let's say I have old suits and everything else. Maybe I paid $500 for the suit. So if I give it to Goodwill, I can write that off on my tax return. But how much can I write off?
Yeah, not $500. It's actually for whatever the current value is. And Goodwill and Salvation Army actually do a pretty good job of giving you a list of those. So if you want to get those, usually, I mean, if you don't know, usually I would take around a 20% of cost or maybe something a little bit lower. That'll at least give you an idea. But yes, giving your clothes, giving your old appliances, giving tools, whatever to charity, you will get a tax deduction. Joe, you give away your old clothes to charity?
Yes, I do.
You wash them first?
Well, they're suits, so, you know.
You dry clean them?
Yes, I dry clean them first and then I give them away. Well, do you think, well, your suits, you probably get a premium because Big Al wore them.
It's possible.
Yeah, whatever. Okay, hey, let's talk about if you want to sell highly appreciated stock, what are some of the things that you need to do? Or if you're looking to give to charity, what type of mechanisms that you want to look at?
Yeah, let's go over this example because a lot of people are not doing this. If you have stock outside of retirement and it's appreciated, here's an example. It's worth $10,000 today and the original cost is a couple $1,000s. You get a tax deduction of $10,000. So, and plus, you don't have to pay taxes on the gain. It's the same for real estate. Now, you're not necessarily going to give your entire piece of real estate, but we're going to go over a strategy that you may actually want to do that. But realize this, if you're giving away cash or check, it's just a straight donation. But if you're giving away appreciated stock, you get the value of that stock as a donation deduction, and you do not have to pay tax on the gain. So it's pretty cool.
Here's another strategy that you might want to take a look at. So let's say that you have highly appreciated stock, and so you want to give more than $10,000, or maybe that you have a piece of property. Now, this is very common. What we see quite a bit is, let's say that you purchased in a single-family resident, maybe it's a tenant in common apartment building, whatever the case may be. You bought it a long time ago, maybe for $100,000. Now it's appreciated maybe to $1 million. We see this quite a bit in San Diego. So let's just take a look at a building here that is now worth $1 million, okay? But you bought it down here for $100,000, and then when you rent out a property, there's something that's called depreciation, and so what happens is that your basis reduces even further. So the problem is that, all right, well here, I don't want to be a landlord anymore. I want to get rid of the rents. I would like to have some liquidity. I have this building in an undesirable place, but there's no way I'm going to sell it. The reason why people don't want to sell is you got it, taxes. You don't want to pay the taxes. So the problem is that if I have $1 million building and let's say it's depreciated down to nothing, I have $1 million gain. If you take a look at the tax code today, you're paying a 20% capital gains rate. You got the health care bill with another 3.8 plus 10% state. You're looking at a very large tax. Let's say maybe almost 40%, 35%, something like that is going to going to the IRS. So $350,000, you got to cut that check and give it to the IRS. Most people say, you know what, no, I don't want to do that. I'm going to hold on. Here's something that you can do. You can transfer this into what we call a tax-exempt trust. Tax-exempt trust. So you put the $1 million building in the trust. The trust sells the building. There is no tax, 0% tax on that sale of property. The trust sells it. It's a tax-exempt entity. Then you could create income from this $1 million. So would you rather build income on $650,000, $700,000, depending on how much tax that you're paying, or $1 million? Well, of course, $1 million, because you can produce more income. So now you're producing a lot more income. You avoided the capital gains tax. Here's the caveat, though. At you and your spouse's death, okay, right here, about 10% of the remaining balance needs to go to a qualifying charity. 10% of the remaining balance needs to go to a qualifying charity. So let me ask you this question. Would you rather pay 10% or 35%? The answer is a no-brainer. Of course, most people would want to pay 10%. Here's the deal. If you give a gift, the IRS will forgive the tax. It's a pretty cool strategy. Of course, there's so many different caveats. I'm talking very high level, but a lot of people don't understand these strategies, and there's a lot of things that you can potentially do to create larger income, sell the property, avoid the capital gains tax, and then here's the kicker. With this $1 million transfer, you also get a tax deduction. Because 10% of the remaining balance is going to go to charity, you get a $100,000 tax deduction today. 100 grand tax deduction today. Now, that will offset higher incomes. You can do different things like Roth conversions. There's a lot of different unique planning that you can combine these things. It's a little bit more advanced, but we're talking end of year tax planning. There's still things that you can do. You can set this up before year end and get a huge tax deduction.
Yeah, Joe, one of the best things about this strategies is you can increase your income pretty substantially, because when you have real estate, you may only be receiving 3-4% cash on cash. When you set up one of these tax-exempt trusts, you may have 10, 11, 12% rate in terms of a distribution, because you're getting income and principal back to you. So you can dramatically increase your income, save on taxes, give to charity when you pass, get a tax deduction today. I'll tell you what, even if you're not charitably inclined, this is a great way to sell your appreciated real estate.
Right. As we said before, everyone is charitably inclined. It's just depending on who you want to give to. Do you want to give to the IRS, or would you rather utilize your capital to the best of your ability, and then at the end maybe give to a qualifying charity, something that you really have passion about? If you don't have anything passionate about, well, find something to get passionate about, because you're going to save a boatload of tax. Hey, we're going to take a quick break. When we get back, I want to get into a couple more strategies that you want to make sure that you utilize before year end. We got your email questions that Big Al wants to talk about. I also want to get into what is called a gift annuity. A gift annuity. So it's like, well, what the heck is that? I don't want to go into a commercial annuity. No, this is something completely different. Some people get confused on the term annuity. It just means income, and you can get a lot of income by doing this strategy, so don't go anywhere. Show's called Your Money, and it's your wealth.